Okay, it looks like the attendee numbers are beginning to stabilize now. So welcome everybody to the TI Apply IRU Q2 2025 webinar on European road freight rates. We're very excited to have another session today and have the chance to talk to you about all of the very dynamic and sometimes conflicting and confusing trends going on in the world of road freight at the moment, with a very complex world of tariff and trade disruption, recovering or very slowly recovering economies, and all the other influences we have on disruption on trade routes and from geopolitical conflicts erupting all over the world all the time, it seems. So today we're going to try and shed some light on the market for you, and we're going to drill into the data to show you exactly what's going on. And at the end, we're also going to try and give you a bit of a view as to our outlook, and we'll also ask for your opinion on that as well. So it should be a very interesting session today. So just a bit of housekeeping. The presentation will last for about 35 minutes. We'll try and keep it within time as much as we can. And then we'll move to a Q&A session at the end. So there will be a 10 or 15-minute period for you to ask your questions. But we do encourage you to ask as many questions as you can throughout the webinar using the Q&A tool on Zoom. We've got a team ready to answer those questions as they come in. So hopefully we'll get through as many as we possibly can before we finish up today. I should also say that we will be sharing a copy of the report and a recording of this webinar session with all participants and registrants after the session today. So if you haven't got the report, you will be sent a copy after this. As I briefly mentioned, we'll also be running a poll at the end of the webinar, asking you what you think is going to happen to rates over the next quarter. So please be prepared to answer the poll. That would be presented to you on Zoom at that point. All right, so it's time for me to introduce you to our panelists. So I myself, your host, Michael Clover, TI's Head of Commercial Development. And as I say, I'll be hosting the session today. For those of you that don't know Transport Intelligence, we are a market intelligence and consultancy firm focused specifically on the global logistics industry, but we have a particular specialization in road freight. So if you have any strategic questions about the market, we'll be very happy to discuss those with you. I'm also joined by my colleague Nathaniel Donaldson today, who's an economic analyst at TI, and one of the key people on this project. He's going to be sharing his views with us today as well. So welcome, Nathan.
Thanks, Michael. Hi, everyone.
In addition, I'm also joined by Thomas Leroux. He's the Chief Executive Officer of Apply, and has been with us through all of these webinar sessions. So welcome again, Thomas. And can I ask you please to introduce Apply to anyone that might not know of the organization yet?
Yeah, thank you, Michael, and hello, everybody. Apply is a transport management platform. We're offering different services from freight exchange, automatic procurement, spot and contract management, invoicing, proof of delivery, all this part that we wanted to build a tech solution. And on top of that, that platform, we are gathering data and we are managing a lot of data to bring some tools like benchmarking or market intelligence. And this is the data that we will use today. And if you want to have access to the data, or if you have any questions regarding market, please feel free to directly contact me or add me on LinkedIn.
Well, and finally, we're also joined by Marianne Savoni. Marianne is the Associate Director, Strategy Market Intelligence for IRU. Welcome, Marianne, to the session. Could you introduce IRU for anyone that doesn't know the organization yet?
Yeah, sure. So thank you, Michael, and good afternoon to all. Briefly, IRU is the International Road Transport Organization. So it means that we represent commercial road transport industry globally. So we count a large diversity of members and partners, being national road transport associations, large logistic companies, service providers, shippers, and even banks. As IRU, we advocate. We advocate at regional, but also at global levels, at UN notably. We manage and we develop solutions also to facilitate the international road transport. And finally, we develop intelligent services, so regulatory monitoring through prices by type of energy, decarbonization, driver shortage. So everything that I represent today is published on IRU Intelligent Platform. And there, if you are interested to subscribe, to know more, do not hesitate indeed to contact me after the webinar. Thank you.
Thanks, Marianne. Okay, so before we move into the session proper, I should just read our disclaimer as well, which is we remind you that all discussions and statements made by participants on commercially, strategically sensitive information may fall within the scope of competition law and be considered as unlawful. We invite you to refrain from sharing any information of such nature or entering into any such discussion, including during breaks. Right, and with that done, we're now going to move on to the session. So of the methodology section, which Thomas is going to take us through and explain for everyone, and then we'll move into discussion around the rates themselves and some of the supply and demand side factors driving the rates we're seeing. But first of all, Thomas, if you could take us through the methodology, please.
Yes, for sure. So this break here of methodology, this slide of methodology, just to emphasis on the fact that the data that we will use today regarding market data, the indexes that you will see regarding the rates within Europe are coming from Upply. This is data that we collect from our users or directly from our freight exchange and our transport management platform. Everything is anonymized and securely managed so that we take this data, and today for this analysis, we are looking only at FTL, full truckload data, general cargo, spot and contractual rates that you will see. The fuel is included in both spot and contractual rates. Sometimes you will see data without the fuel and it will be clearly stated. And this is the methodology that we have today for this webinar. We try to stay global. And with the FTL data general cargo, we have more data, different type of trucks, different type of reefer or bulk, for instance. So if you want to have more details on that, feel free to come to see us directly.
Thanks, Thomas. So we'll move on to our first content slides now. And first of all, we start looking at the overall index right across Europe. So this combines all the lanes that we cover for international lanes anyway, into one index and splits it out into contract and spot. And really interesting dynamic this quarter because we've seen contract and spot converging with contract rates increasing, but spot flattening. So some interesting dynamics to get into, and Nathan is going to take us through the trend.
Yes, thank you, Michael. Yeah, so as Michael mentioned, we've seen the two indexes converge in 132.2. And then just to confirm what this means, so the indexes. So this is an index traded relative to the price of both markets, of each market back in Q1 2017. Doesn't mean they're exactly the same price. It all means that they're following the same trend and has put them both at that 132.2 index. But to go in and discuss the actual changes then, if we first just have a look at the spot market, so it's slid for the second consecutive quarter, and this time it was a movement of minus 2.2 points, which dropped it down to that 132.2. And that now puts it down 2 points year on year. So minus 2.2 points quarter on quarter and now down 2 points year on year. We then have a look at the contract market. Well, this rebounded somewhat. That was up 1.2 points quarter on quarter to 132.2 and up 0.7 points year on year now, if we compare it to a year ago. In terms of the story, I mean, it's quite a complicated story. Of course, there's lots of caveats in each point, but the top level story is one of easing and lowering short-term demand, and that allowed the spot fall that we saw, and that's a result of both lower short-term pressure from lower demand, lower costs, namely fuel, which we'll go through on a later slide as well. In terms of the spot rates, they've now dropped to their lowest point since late 2023, as expenditure has weakened. And we've seen this in household goods. So in terms of the recent changes, the spend in household goods in Europe was down 2.2% quarter on quarter. Vehicle sales down 3% quarter on quarter. But then, of course, we also have the fact of the tariffs, which we'll get to in a moment. In terms of the longer term sentiment, so when we look at the contract market, European production is actually rather steady. We've seen some increase in the production of durables up 1.1% quarter on quarter, and non-durables up 4.4% year on year. So in terms of previous years, we actually see that longer term environment is actually improved somewhat, especially manufacturing, which has been extremely negative, and maybe allowed us to see a little bit of that upwards pressure on that rebound in the contract market. Now, if we combine this with a PMI growth for Europe, which is now 49.5, now that is below 50, which would suggest growth, but it is the highest level that we've seen since August 2022. So a slightly improved manufacturing environment overall in that longer term view, which has provided some pressure to the contract rates, in addition to low inflation and now now at 2% and lower interest rates. In terms of the outlook and the other factor, of course, mentioning the tariffs, there's a lot of uncertainty there, which we'll go into on some other lanes. We've seen that more affect that short-term demand, even though that longer-term manufacturing seems somewhat improved. We're seeing some lower pressure and a lot of uncertainty there. So we're likely to see the spot rates face more downward pressure as that uncertainty exists and pushes down general European economic sentiment. However, we see that the total economic environment in Europe is improved. We have lower interest rates, we have lower inflation, we have somewhat more positivity, although a lot of uncertainty. But then we have that on the other side, which we don't know what might happen with the US trade policy, which could affect any potential European growth. So generally, we're seeing right now low pressure and downwards pressure on short-term spot rates, improved expectation over the longer term, still elevated over the cost, but also we've had some easing pressure from the fuel and a lot of uncertainty from tariffs and trade policy.
Very interesting to look at, yes. So thanks for that overview, Nathan, and we'll move on now to just drill into a few more of the underlying factors, really. Firstly, starting actually with a look at demand and volume development over the last few years here, looking at some new data from IRU, and Marianne's going to take us through these charts.
Yeah, absolutely. So again, as mentioned, it is difficult to make any forecast or estimation, but it is good to have this global overview that we update on a regular basis. So you can see here on the graph the evolution of road freight volume in trillion ton kilometer. So from 2020 until 2024, and an IRU forecast for 25 until 2026. So here, important to mention, the measure of road freight volume we take here is ton kilometers, because it reflects the most of the best the transport intensity of road transport. Tons here serve as a proxy for weight, while the kilometers represent the distance. So it is a very good way to really measure the performance of volume. So you can see that in 2023, the volume fell slightly, reaching 1.86 trillion ton kilometers, so 3% less than in 2022. And the volume is recovering in 23-24 as forecasted by IRU, reaching approximately 1.87 trillion ton kilometer in 2024. So something important in terms of analysis to be mentioned here. The 2/3 of the total EU road freights that you see here are transported nationally. However, some countries, and it is the case of Lithuania, have international operations accounting for more than 90% of their total freight volume. Exceptions include Spain and Poland that are expanding both their domestic and also their international road freight volumes. And I would like to mention that because it reflects their robust local demand and the competitive transport prices, which is important for the analysis. And then for the forecast, the road freight activity in the EU is forecasted to show, you see, a continuous modest increase in 25, reaching 1.91 trillion ton kilometer, and which is supported, and you will hear a lot about that, and it was already mentioned, a steady industrial output and the improving producer sentiment that we observe already in Q2. So this is signaling a reactivation of the manufacturing and mining sectors that are likely to support the road freight volumes over the coming quarters. Again, as mentioned before, this picture is really, depending on the ongoing tariff uncertainties and the policy disruptions that are going to happen in the coming quarters. Thank you, Michael.
Okay, thanks, Marianne. And before we move on to some of the supply side slides as well, I think it might be worth addressing one or two of the questions that we've had already just concerning restatements on the index. And Thomas, I think you're happy to tackle that one.
Yeah, it was really the first questions on the previous slide that indeed the previous slide can change from one webinar to another. The index might change very slightly, and we are looking at that. And honestly, the changes are very, very, very low, about 0.5, 0.2%. Why is that? Because we use what's called not chain, unchained indexes, meaning that all the data that are coming today and can be on the past have an impact on the index. And we make this choice for this webinar because this is at a specific date, and today we have, with this methodology, the most accurate index at a specific date. We do have chain indexes apply that doesn't change with the past, but here this one might change, and it changed very slightly. Just to answer to the question of Thierry.
Yeah, with the philosophy of the latest and greatest data
Exactly.
being applied, of course, as we apply is collecting so much valuable data on the market. All right, thank you for that. All right, so the next section is really looking at supply side, and again, this is some really interesting IRU data coming through here, starting on diesel prices. Then we'll move on to drivers and tolls as well. But Marianne's going to talk us through these slides.
Yeah, sure. So we show here a graph showing the index of diesel prices at pump for specific countries, for France, Germany, Italy, Poland, and Spain. Diesel prices at pump reached an average of 1.5 euro per liter in Q2. So this is showing a decline of 6% versus the last quarter, but prices rebounded at the end of Q2. And obviously this is due to the Israel-Iran war that has created uncertainties about Iran's oil exports and then tensions in the global oil supply chain. So on the other side, the Brent increased from 66 to 76 US dollars per barrel from early to mid-June and has stabilized around 69 US dollars in July. As of today, tensions are easing in the Middle East, and so OPEC plus countries announced in July last month that they will increase the production starting from August again. So therefore, the last forecast of the Energy Information Administration has revised its evaluation for the Brent price for the end of the year from 68 US dollars to 69 since their latest update. Just a few words on HVO or biofuel prices. As a reminder, biofuels are very close to regular fuels and offer a way to reduce the carbon emissions without any major changes or disruptions to engines, but also in the fuel distribution network. So this is a readily decarbonization solution that a lot of carriers are implementing today. And according to our last survey that we are going to publish in the coming weeks, biofuel is expected to remain the dominant solution over the next 5 years. And this is clearly something that was stated by the carriers we have interviewed. Of course, while electricity is gaining momentum at the same time. Why I say that? It means that the HVO distribution is ramping up, meaning that the prices at the fueling stations are going down on a yearly basis, having decreased by 6% in the last quarter-to-quarter comparison. However, HVO prices remain higher than diesel. The average price for HVO is about 1.81 euro per liter in Q2. And it should be noted that despite the recent decrease in diesel prices, HVO pricing is remaining stable. If you want to access the full detail of all the energy prices, you can subscribe to IRU Fuel Prices, and you can ask any questions after the webinar on this type of information we deliver. Thank you, Michael.
Thanks, Marianne. Yes, and there's a bit more detail in the report as well. So I think we've just established that we've got some uncertainty around demand, although we've got a really useful forecast here, and even more uncertainty perhaps around fuel prices as well. So that's two key factors that is quite uncertain to look at. And perhaps we can find a little bit more certainty as we predict or look ahead at what might be happening with truck drivers based on some of this demographic data, which I think is really interesting to see divergence and also to benchmark the European market against some of these international comparisons as well. So Marianne, could you explain this new data as well, please?
Yeah, so this is something that we do on a yearly basis in terms of updates. Something very important is the age distribution. So this is according to our last driver shortage report. And you can see here the truck age distribution, not only for Europe, but also for US, Mexico, Argentina, Turkey, Uzbekistan, and Australia, to have a comparative overview. And there are two main messages that you need to take today when you see this slide. First, Europe has the lowest proportion of young drivers, 4%, compared with the other regions. So there is a clear difficulty in Europe to attract the young to the profession. Second message, many regions have a high proportion of drivers over the age of 55 in dark blue in the graph, which is the case of Australia, Europe, and the US. And in Europe specifically, you can see that we speak about 36% of truck drivers over 55 years old. So we know that truck driver shortage continues to intensify. You know this number of 400,000 unfilled positions that we have unveiled last year, and we are used to say that you have two, I would say, elements behind these figures. You have two ways to see it: the access to the profession and the attractiveness of the profession. And the access to the profession, it means, for example, the high driving license costs. So to give you an idea, it's about, in average, it's about 5,000 euro in Europe to have a license. Second element, the minimum age to access the profession, so to enter in the profession, and the difficulty to hire non-EU drivers. And when we say attractiveness of the profession, we mean here the long, I would say, period spent away from home, the lack of secure parking areas. We know that in Europe we have too few number of parking spaces that are secured, only 5,000. And finally, the poor treatment of drivers or delivery sites. So just to say that we have an emergency to find a solution, because in the next coming 5 to 10 years, we'll have this big wave of drivers going to retirements. And we estimate that it is about 600,000 truck drivers that will retire in 29. So solutions, we track a lot the different solutions implemented by the different carriers or by different large logistic companies to really retain drivers with different carrier path development, etc. But in terms of, I would say, regulatory institutions, EU institutions have reached a political agreement, which is new, between the Council, the European Commission, and the Parliament last month to align on 18 as the minimum age to access the profession, and even with a training permitted from the age of 17. So this is the big, I would say, the big new thing, because then the member states will have 4 years to transpose this new regulation into their implementation. So just wanted to mention that, because it is the three, I would say, divisions or departments of the European, I would say, institutions that agreed on this. Thank you, Michael.
Okay, and we'll then move to the latest update on tolling as well.
Yeah, and very briefly on this one, yeah. So this is a map that we do with the updates every month, or every 2 or 3 months, depending on the different information we want to update. This is part of a dedicated monitoring we do at IRU. So we consider here the toll prices evolution as a whole, so it includes the CO2 toll taxation impact. And so the colors are showing if the prices are increasing, which is in yellow, if the prices are decreasing in green, and if there is no change in light blue. And we can clearly see that in Q2, you have a lot of countries in yellow, notably Bulgaria, Spain, Italy, Poland, Netherlands. And the toll increase ranged from plus 2% in Italy to 20% in Bulgaria, for example, on a year-on-year comparison. On the CO2 toll implementation, Denmark changed in January its tolling scheme, applying for a new digital distance-based instead of the time-based, making the country compliant with the latest Eurovignette revision. And also Netherlands, Luxembourg, and Sweden applied end of March the CO2 component to their time-based fee. So, which is raising the prices by 2% for Euro 6 Class 1 articulated vehicles, to give you an estimation. And just to finish, since July 1st, you maybe saw that Slovakia is now implementing the Eurovignette revision, adding also the CO2 component to their distance-based fee, taking into account the CO2 class of vehicles. Thank you.
Thanks, Marianne. That's an excellent update on tolling there. And okay, so we'll move on now to our slides, first looking at individual rates. And to start with, we'll look at some of the domestic data from Upply, this time looking at the domestic contract rates for some of the largest road freight markets in Europe, and Thomas is going to take us through the key points here.
Yes, thank you. I will here talk about the global trend, but and focus also on Germany and Italy, because just after we'll see others trend and other countries, especially France and Spain. Here, what we see clearly is that first, global stabilization of the contract rates over the past quarters. When we see what happened just after the COVID, this big increase here, we are more in a stable part of the market, season of the market, let's say. Germany is still a bit up and down. If we average that, we see that contract rates have increased very slightly. This is the same also for Italy. If we look at the underlying parts, the economy, first starting by Italy, the domestic market of Italy is going, I mean, is increasing, let's say, plus 0.7% year on year on the global GDP. And this growth is mainly taken and driven by the domestic demand, which is quite good, and which might explain also this increase of domestic Italy contract that we have seen over the past quarters, because it was quite stable for the two last years. And we have seen the 2 or 3 quarters in a row increase, still slight increase. It's not a big increase, but still an increase over the contract for Italy. In Germany, we have seen an increase over the 2 or 3 past quarters after a decrease. So let's say that in average, there is a quite stabilization for Germany. If we are looking, and over the past webinars, we talked about the fact that Germany, the global economy of Germany was not in a very good shape. It happened, it seems that the German retail sector is showing a stronger momentum than expected. If we look at the past quarter, it's plus 9% increase for the retail sector quarter in quarter, plus 5% year on year. So it's good signs, honestly, for Germany. And if we look at the outlooks for these two main countries, and this is true also for Europe, globally speaking, I mean, it's difficult to predict what might happen, especially with the trade tariffs and the negotiation that are entering round 2 between Europe and the US. And just to mention it, and as a recap, a reminder, Germany and Spain, and Germany and Italy are the two major countries in Europe that are exporting to the US, so that they are the first two that might have a strong impact with what is going on between Europe and the US right now regarding the trade tariffs.
So we'll keep watching those quite closely. So it's an interesting picture of relative stability in many ways in the domestic contract market, but the spot market, as we would, I suppose, expect, is a little bit more volatile, or quite a lot more volatile. So Nathan's going to try and explain the trend we see going on here and what's behind it.
Thanks, Michael. So we will, for this section, we'll just focus on Spain, as it is a bit of a different story. But as Michael mentioned, it's much more volatile, and we're seeing very different changes. We're seeing that fall in the German spot market, which we will go into in the next section, and then we're also seeing an increase in the Italian market and quite a steady French market. But if we focus on the Spanish market, which is the light grey line that you can see rising sharply at the top there, we have a domestic spot rate that's sat at an index of 151.2, and that's in June. For the month of June, that's up 8.1 points quarter on quarter and up 12.1 points year on year. And I think we've covered it in a few, we've covered this in a few other webinars, but it is a very interesting and different story. And actually what we're seeing this quarter is a serious tightening of the market following many quarters of us explaining the fact that the demand from Spain is much stronger than the rest of the European continent. So what we're seeing is the Spanish economy, it continues to add pressure to road freight rates. We've got a Spanish market that is benefiting from its competitiveness as we look across the other European countries and the rest of the world as it saw lower price rises. So it's benefited, and we're seeing this in numbers where we see production of cars, which is up 5.6% quarter on quarter. See production of pharmaceuticals up 9.5% quarter on quarter, and then consumer electronics even, which is up 4.7% year on year. And so what we're seeing this year, what we're seeing now is large increases in the Spanish spot rates as the road freight market is now tightened significantly. We've seen that there's now a lot less spare capacity in the market. There's been a growing demand for a considerable period of time, but not a growing supply. And now we're seeing large increases in this spot market. The rest of the market, obviously, the rest of the countries is a varied story. And we do go into those changes in terms of quarter on quarter, year on year, and the drivers of that in the paper, which you will receive after the webinar.
Thanks, Nathan. All right, so as an interesting highlight on the Spanish market for these spot rates there, but we'll move on to international lanes now and show some of the key lanes and developments here. This time looking at contract rates, and Marianne's going to talk us through the trends here.
Yeah, sure. So you can see here on the slide a graph showing the contract rates for 5 international lanes. So you have from Madrid to Paris in gray, from Warsaw to Duisburg in light pink. You have from Duisburg to Lille in red, from Lyon to Birmingham in brown, and finally from Milan to Warsaw in black. So clearly, all lanes are on the rise except Milan to Warsaw, which is showing a continuous decline since the Q4 quarter last year. Which is likely due to the weakening Polish industrial demand and a small drop in the operating costs on these routes, notably the diesel prices in Italy that are falling by 4% quarter on quarter. In the meantime, the PMI in Poland is showing signs of recovery, which is surpassing the 50 points threshold in early 25. And when you are looking ahead, a particular strong growth is expected in key sectors in Poland, which is the case of automotive, furniture, pharmaceutical, chemicals, electronics. So I think the situation is going to quite evolve rapidly. The contract rates on the Lyon to Birmingham route are up both quarter on quarter and year on year, which is potentially reflecting a rebound in the UK import activity, and notably from France. And indeed, UK has seen a rise in imports of machinery and transport equipment, an increase of automotive imports from the EU alone as well, driven by the rise of car imports from Germany, and which is going along with a notable increase in the medical and pharmaceutical products from France. And finally, from German export to France, you can see that there are low rates that are following the broader signs of stagnation in the German manufacturing, where industrial orders have declined, which is the case of 4.5% year on year. So the output expectations remain flat quarter on quarter, and the sentiment has worsened year on year. And those macro indicators are really continuing to hold on the contract rates. Thank you, Michael.
Thanks, Marianne. Yeah, very interesting to see those dynamics there, and generally trending up those prices. So we'll take a look at the spots and see what sort of contrast or whether it corroborates the story of the contract market. But as you see, it's quite different again, and Nathan's going to explain what's happening here.
Sure. So I think we did actually have a question as well around the spot market. So the spot index that we showed was an average of the major lanes in Europe, those changes quarter on quarter. And I think what we see here is why we saw the figure that we saw. So we see that 4 out of these 5 lanes that we're showing here did see a fall quarter on quarter in the most recent data. And then it is a slightly mixed picture, but largely we're seeing them edging downwards, apart from that Warsaw to Duisburg lane, which has been very volatile over the previous 2 years. Anyway, so what we do see here to focus in, I think the rates from Duisburg to Lille is a really good example, because we're seeing that large drop here. Now, if we look at the actual data from Duisburg to Lille, that's a 9.5 point drop quarter on quarter, and that's 13.5 points year on year. Now, this is really due to a combination of weak short-term demand lower costs, but largely around that heavy uncertainty, weak and short-term demand. Now, new orders is a good way of understanding what's happening here, and Germany has some really good information on that. So if we look at Germany's new orders, we see that new orders for machinery is down 12% quarter on quarter. Chemicals are down 11%. So that's really big drops. Usually would use that to reflect the long-term outlook, but actually this works really well to look at the short-term situation here, because this is actively affected rates in the short term, as we see that a lot of shippers, a lot of buyers are deterred by that uncertainty. They're unsure whether to buy with what's happening with the tariffs, lots of changes with the tariffs, aiming to avoid those higher tariffs. And when we look at the region, Duisburg to Lille is a good example, because those manufacturing sectors are so closely linked, both with finished products and intermediate products. What we're seeing is an immediate reduction in that short-term demand, increased availability of spare supply, and that's pulling a lot of rates down in that spot market across Europe. And that's what we're seeing here in 4 out of these 5 lanes. The outlook is hard to say. The uncertainty continues. If the uncertainty continues, we might see something similar. But at the same time, they could increase if the economic conditions in Europe improve.
Yeah, thanks, Nathan. Well, I think it's interesting really to look at that dynamic between spot and contract, and whatever we can argue or points we can make about the demand side and supply side facts influencing those rates. A lot of those dynamics are around human factors and managing risk, and whether we're looking at securing rates on contracts or not wanting to put orders through, hanging on. We see that softening the spot market. So in that vein, we're going to move on to our next slide now, which is asking you for your perspective on rates and your expectations. So I'm going to launch the poll, and I'd like you all please to participate in that and give your view as to what you think is going to happen over the next 3 months in road freight rates. And while you're doing that, I will just explain the data that we've had in the sentiment index up to now, and particularly over Q2, because this was the last Q2 2025 measure from the prior webinar. And we saw that there was a general tendency to expect a minor increase, or a slight increase in rates over the next 3 quarters. And that's sort of what we saw in contract rates, but not really in the spot market. So that showed the general trend underlying contracts. And actually, that was a slightly lower score for increase than the prior quarter as well. So it'll be interesting to see how things have changed. I don't know if there's any more certainty. Perhaps there's a less certainty now than there was last time around. So it'll be interesting to see what you make of it. All right, well, it looks like we've got most of our answers in now. So I'm going to end the poll and share our results with you. So you should be able to see them now on your screen. And well, it looks like broadly there's the same sort of expectation of a slight increase there. And actually, we had 38% expecting a slight increase last time and 46% this time, so a greater tendency. But Thomas, can I ask you to give your quick take on that?
Yes, my quick take will be that I'm not very surprised about the results. There are still some people that say they will decrease slightly, and this is linked also. I will take a comment that I just saw from Marcin, I think, in the chat, that's saying that I confirm the situation in Poland, where there is a huge competitions, making spot rates lower than previously. So we have places in Europe, and depending on the demand and offer, basically on the low of the market, where rates are decreasing or rates are lower than expected or than normal. But globally speaking, I mean, if I quite agree with the global trend that we see here in the pool, where we have increase of many parts of a rate, from the ETS, from the toll parts, with all what is happening on the CO2 regulations. So we can expect, and we might expect, I think, for next year or the quarter to come, an increase of transport rates, but not a big increase. We're talking, I remind, 1 to 2.5% maybe over year, mainly linked with inflation, and maybe also depending on the demand that we have, We know that carriers are facing inflation. If the demand is high, they will be able to pass this inflation to shippers. But if it's not the case, carriers will be in a tricky positions once again to not be able to pass all this inflation to shippers. And we know that the situation of carriers right now in Europe is not, I mean, it's quite difficult. So the following months and quarter will be quite important to watch for that. And this is my last word on that. So I quite agree with the poll on this part. And if I had to make a guess, I think we will be on a slight increase, 1.52% for next year.
Yes. Yeah. Yeah. So that with the sort of relatively benign cost environment at the moment, that seems likely. That rates at least aren't going to do anything completely wild through the second half of the year, but lots of things, of course, could change that. All right. Well, thank you very much, everybody, for joining us for the session today, and thank you to all our panelists for sharing their expertise and views on the market's development. We've had a lot of questions come in, so as we move on to our Q&A session, we will try and deal with as many of those as we possibly can. I'll just open up the Q&A section for us now. Lots of questions. All right. We've answered a few as we've gone through this time. So I will take this one first. So this one's one for Marianne, I think, just about the driver age data. Is there more in-depth data available, especially within the 55 plus bracket? Do you know?
Yeah. No, I'm not at this moment. And just I wanted to mention that in the next report that we are going to publish at the end of the year, we will have a more granularity of the above 55. So we will have more detail about the 60, above 65. So just to say that is something that we will add. We don't have much clarity on the really the age of retirement depending on the countries until you know which age some drivers are really in a way in a situation to continue to work at latest as possible. So we will have this information in the new report we will release.
Okay, fantastic.
We can fine tune the forecast for that, yeah.
And there's a few just on similar sort of note. There's a few questions around policies to bring drivers in from other regions as well. So what would be your take on that?
Yeah, so here today the European Commission, and we are collaborating with them on that, are implementing different pilots between European countries and non-EU countries. This is notably the case of Maghreb countries and Pakistan. So there are some pilots to ease and to make it more, I would say, harmonize the way we can recognize and we can train drivers that are coming from those regions to work inside Europe. So it's something which is really starting with Maghreb and Pakistan, and to be continued. And IRU is strongly supported the European Commission on this aspect, so that we can have impacts quite soon with those drivers to mitigate the driver shortage I was just mentioning.
Yeah. One question here, maybe for you, Nathan. What would you point to as the major drivers behind the divergence between spot and contract at a high level? It appears spot, like Spain, is down versus contract up almost across the board. So what would you say are the main drivers there? I know you covered that a bit in your remarks, Nathan.
Sure, I would say the spot falls are more due to the immediate situation and pressures that we're seeing, especially around the uncertainty around tariffs, around international trade, and the evidence that we saw from the new orders. We see that's falling, and international buyers are really uncertain about buying the international goods with the uncertainty around the tariffs. Whereas if we look at the contract market, really, even though things don't feel hugely positive in Europe, it's a much more positive situation than what we were looking at maybe 6 months ago, definitely 12 months ago, and further back. So that expectation of the output, the long-term output for manufacturers and retailers in Europe has actually improved quite a bit. Versus when we're looking at this, like I say, a year or 2 years ago, and the general economic sentiment in Europe has improved. So I would say that would be the difference, even though things feel really uncertain and don't feel hugely positive right now. It's probably actually a lot better than it was, and that long-term expectation of volumes is higher, whereas spot is just being affected by the uncertainty right now and deterring purchases.
Thanks. And there's another more technical question, maybe just on the IRU driver shortage data about changes over the last couple of years. I don't know if you'd like to address that, Marianne.
Yeah, very briefly. So indeed, we have changed the methodology versus the previous years to make it more, I will say, precise in terms of size of the markets with different ponderations. So at the end, it doesn't change the message because the driver shortage is increasing a lot in any case. So indeed, if you want to have more information on that, we can definitely, you can contact me and we can give you some more detailed information on the methodology.
Brilliant. Thanks, Marianne. Yeah, we've really seen that data grow over the last few years, haven't we? One other, I suppose, little question is, will we see the report sent out after the session? Yes, we'll be sending copies of the report out to everybody who's participated or registered for the session, and indeed you'll get a copy or recording of the webinar as well on that one. I've seen that we've also had a couple of other questions on the situation in the Polish market, and I think Jamal, you had some interesting comments on that regarding the sort of capacity in the market and the situation for carriers. Is there anything you'd like to add on developments and the situation in Poland?
No, no, sorry. On this situation, I was just taking this example because indeed it's difficult when you have index that are aggregated to understand exactly what's happening in the market, and indeed it can be a bit shocking or a bit surprising that spot market can be decreasing in certain parts of Europe and increasing sharply in others. I was just taking this comment over there. Honestly, I don't have specific details of what is happening in Poland. I know that we have market insights and you have also reports on this topic. So please feel free to go and have this information. That's it.
Yeah. Right. Yes, thank you. Yes, so in the report we do discuss the situation in Poland because there's quite interesting trends in looking at the Polish market, of course, and the relationship with what's going on in Germany as well. So please do take a look at that report for more information on that. But one other question, then again back to drivers really, but is the law about the minimum age to drive trucks voted and approved, and when will this new law be in place in Europe? And that's one for you, Marianne, I think.
Yeah, sure. So as mentioned, yes. So it's the European Commission, the Council, and the Parliament that have agreed and voted this new law. So now the member states have 4 years to transpose those new provisions into their national law, and then to prepare for its implementation. So this is the status. So yes, now it is going to be the implementation and national law to be, to include this new provision as a next step.
Thanks, Marianne. And we have another question here just asking, do we have percentage growth forecasts in terms of growth rates for road freight in EU for H2 2025 and 2026? Well, IRU, I think, presented their forecast for volume expectations for the next year. TI does also provide forecasts for market growth in value and volume terms as well. So I'm sure both organizations would be happy to discuss that with you if you wanted to know more about the forecasts there. And another one for you, Thomas. It's what are the main macroeconomic factors influencing freight rate trends in Q2 2025? Perhaps that'd be a nice one to round us off with, if you'd like to answer that one.
Yeah, what is influencing the freight rates in globally speaking or in a specific country? I think you can write a full thesis on this topic, honestly. If we're taking the main factors, when you look at the correlation between the freight rates and the economy, you have the GDP, you have the exports, the imports, you have the different statistics, locally speaking, from the countries, the increase of consumption, the increase of retail. But globally speaking, what we see is that the freight industry or the freight rates are really they're matching what is happening in the economy. So if it's a law of offer and demand, and you need to see what are exactly the offers and all the questions that we are regarding the number of trucks, drivers, position that are on field, the number of trucks that are produced, and on the other side, the demand, really the GDP, the growth. I think with that, you start to have the key factors and you need to use this one to try to understand what is happening on the freight rates and to try to forecast it. But honestly, this is very heavy work, and a lot of people have worked on that and are still working on this topic.
Yes, absolutely. All right. Well, thank you very much, Tamar. And I think we've answered now 40 questions verbally or by text. So that's fantastic. Well done to all the team behind the scenes answering those questions on text for us as well. And thank you very much, everybody, for joining us this afternoon for our latest webinar. We always appreciate you attending, and we hope you all enjoy the reports when you get a chance to read it in more detail. So all that remains really is for me to thank our panelists, Nathan, Tamar, and Marianne, for giving their views and their time today. And we look forward to seeing you next time. Thank you.